Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Hello and welcome to Live Squawk's Commodity Corner on Wednesday, the 24th of June, 2026. Over the next 30-odd minutes, my guests and I will get to grips with the key stories moving the commodity markets and look at the implications for investors. We're fortunate to be joined by Rory Johnston, Toronto-based oil market researcher, founder of Commodity Context. He's also a lecturer at the University of Toronto's Monk School of Global Affairs and Public Policy. He's host of the Oil Ground Up podcast and a fellow with both the Canadian Global Affairs Institute and Payne Institute for Public Policy at the Colorado School of Mines. Rory is arguably the most cited independent oil market analyst in English language media, having become a go-to voice during the unfolding of the Iran-Hormuz crisis. Just a quick disclaimer before we get into it, before I introduce Rory in person, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to welcome Rory. Rory, how are you?
Not bad. How are you doing?
Very well, thank you. I don't know if it's as hot over in Toronto as it is here in London, but we're hitting 35 degrees plus at the moment, and it's as glorious as that may sound. We're not a country that's equipped for really nice weather all the time.
No, yeah, you've got it far warmer and with far less air conditioning. So seriously, my sympathies on that.
Yeah, well, we can talk about that and the gas price and what that's like to do in a minute. As we speak, well, within the last couple of hours, front-month Brent crude has fallen below $75 a barrel. That's the first time it's done that since the Iran war began. And that's on the back of, I guess, this ongoing peace talk and negotiation rounds that we're seeing between the US and Iran at the moment, and the current ceasefire and cessation of war between Israel, the IDF, and Hezbollah in Lebanon. With all that in mind, one of my questions is, and it's an uneasy truce between all parties, really, how much faith can we put in the current truce talks and everything else, and the subsequent effect on oil prices? As you said, we've seen oil fall, so obviously people are feeling a bit happier and a bit more content that the worst of this is over. But can you see this being sustained, both from the war perspective or the crisis itself and the lower oil prices?
Yeah, so let's split that up a little bit, because I think that in terms of, can I see this kind of détente post-MOU reality in the Middle East being sustained for a while? Yeah, I think that at this stage, it's pretty clear that the White House does not want to re-engage in war. And Iran, by all indications, got a pretty great deal out of this MOU, got most of what it wanted. And the Trump administration really did cede ground on a lot of its prior red lines in order to reopen the strait, which I should remind everyone was always open prior to this war in the first place. So you basically had a full rewind of the Trump administration's goals to get back to our kind of prior status quo. That said, I do think what we're seeing right now in oil markets is the initial surge of ships that had been trapped in Hormuz, in the Gulf, in the Persian Gulf, now for well over 100 days. Those ships are all leaving en masse. And we are seeing really big numbers coming out of Hormuz, by far the largest we've seen so far in this crisis. Some days even getting upwards of almost 20 million barrels a day, which was the prior kind of normal level. But I think the important thing to stress here is that these levels, those levels themselves, the exit pace is not yet sustainable. Because what we're seeing is a drawdown of those prior stranded ships. And I think when you can think about it like the stranded ships in the Gulf were effectively a stockpile that was trapped and was not available to the market. But it wasn't real production. Production was still shut in. So as Hormuz began allowing, as Iran allowed more ships to transit Hormuz, you drew down this stock of non-market accessible oil and are making it now accessible to the global market. At the same time, you're seeing this new surge of supply, or this renewed surge of supply, running up against still very weak demand, particularly from China. And we'll talk, I'm sure, in a second about how China was by far the largest swing factor fundamentally in this crisis, that we saw China reduce imports of crude oil by upwards of 5+ million barrels a day, and alone swung more than the rest of kind of the collective action of the IEA states. But right now, those Chinese buyers remain largely on strike and have not returned to the market. So we're seeing this kind of fascinating reality where, despite the fact that we're still in this very disrupted oil market, the oil signal is basically flipping towards contango. And I just see on my screen literally 4 seconds ago that the Brent prompt time spread, the difference between the first and second Brent contract, just flipped into contango for the first time since before the crisis. And that signal, contango, is typically indicative of a surplus of supply, which certainly isn't what we would have expected to see at this point in the crisis.
That was great timing, because it was my next question. So effectively, the oil that we've got that's been stockpiled in the Strait, that's all spoken for. So that, in terms of its demand, is replenishing the demand that had all been spoken for months ago, I presume. They haven't gone elsewhere. This oil is going to a place because that place has asked for that oil, and therefore it will take receipt of that. But like you say, with China is the demand destruction too strong a word for what? Because it was one of my other questions then about evidence of demand destruction. We can get onto that, but so effectively, we've got a load of oil that's been dumped back on the market, or will soon be available onto the market as such, without any real new supply or new demand being seen. And also, I wanted to ask as well, this double-edged sword, the destruction we saw to a number of plants within the region is also a problem, isn't it, in terms of oil production on a normal level?
Yeah.
That is a question.
Yeah. So let's again. So we'll split those two in half again. So I think you had mentioned something about China and demand destruction earlier, and then we'll talk about the kind of production element.
Sure.
So China and demand destruction. I think it's important to note here that while imports, and I think import demand destruction has certainly been a thing, we have seen far fewer signs that you've seen true demand destruction in China as we would normally think about it, which is, fewer people driving, fewer people flying, et cetera, et cetera. The scale of the supply, of the import contraction that we saw, indicated a level of demand destruction just on the flows basis alone, how we would normally estimate, on par with what we saw in COVID zero in 2022. Now, then you start to look at some of the mobility indicators, intercity traffic congestion, flights, truck transits, et cetera. And all of those are showing no real sign of pressure or downgrade as you would expect if we were really seeing a decline in demand in like a true consumptive sense. So what's left? And I think the answer is that I think we did see some demand destruction or demand substitution when it came to, say, the petrochemical industry. This is an area that, you can have some flexibility given the degree of chemical manipulation going on. You can source some of those precursors from natural gas, or in China's case, even coal. And I think that did help nudge the needle a little bit. But I think more generally, what we've likely seen is a very, very large drawdown of Chinese inventories of petroleum, both underground strategic crude stocks, but I think even more importantly, a drawdown in, product stocks, jet fuel, diesel, gasoline. And if we're just looking at the delta between imports, say, of the 3 months prior to the war and what we've seen in the months since, the total cumulative kind of reduction in China's imports during this period is somewhere in the ballpark of 400 to 500 million barrels, which is, again, a staggering sum, given that we're going to talk now about production. And the production shut-ins in the Gulf, which at this stage have resulted in the cumulative loss of Middle Eastern production on the order of 1.3 billion barrels. But 400 million, 500 million, that's a huge chunk of oil. And that is, I think, larger than any other constituent, offset or policy adjustment that you've seen through this crisis. As an example, the IEA member states, the 32 member states, collectively agreed to the largest release of strategic stocks on record, and that was 400 million. And those still aren't all done yet. So if we can talk about, like, China has already potentially swung the market more than the collective IEA states engaging in the largest intervention in the history of the market. And on top of all of this, we've still seen commercial stocks draw at their fastest pace on record. So all of the evidence of the loss of supply is there, but the timing, I think, is funky now. Now, going back to this question of production, now we were talking earlier about the transits and how this is draining down like a stockpile of stranded oil. This is the tankers that were stuck in the Gulf. What's really going to signal the end of this crisis is the resumption of loadings, not just transits. And by loadings, I mean filling new tankers with oil, because that is what's going to take pressure off of the upstream sectors in these countries and allow them to restart the production. And the number we've been using generally through this crisis, I think that's a little lower now. But at the peak, we had upwards of 13 million barrels a day of liquids production that was shut in across the Gulf. That was non-Iranian production. What we've seen so far is that loadings, which I think, let's say, take as our proxy for production, those have risen from about 2.5 million barrels a day back to around 4 to 5 million barrels a day.
Okay,
There's an improvement, but it's this is relative to pre-war of 20 million barrels a day.
Okay, interesting. And we talk about refined products then. What does this do to pricing then? So again, for those maybe less familiar, you can trade futures and you can trade months out. So you can trade the front month, you can then trade the next month or quarters or whatever. So for futures traders, they look at this. They don't look at currently just the front month and further out. I want to talk about refined products, for example, diesel and jet fuel. I read a bank note that said the prices of jet and diesel fuel will remain stronger than crude oil prices over the next, say, 6 months at a minimum, as inventories will still draw. Do you agree with that assessment based on what you've just said?
Yeah, I think so. One thing we've definitely seen, and you mentioned some of the damage to facilities in the Middle East as well. And what we have seen is that, while I think generally most of the upstream production has not seen durable damage, we have likely seen more damage to refineries, petrochemical facilities, other downstream elements that transform crude oil and petrochemical and other petroleum products into the products we actually use and consume, like jet fuel, diesel, gasoline, etc. So as an example here, gasoline right now, which is normally around this time of year trading at a crack spread, or basically a refining margin of around $20 a barrel, is currently sitting right now at more than $47 a barrel. Diesel, which is normally also around $20 this time of year, is currently trading for almost $60 a barrel of crack spread. Right. Those are your signs that there is still tremendous stress in the refined products market. And on this, we can say not only that it's due to the Middle East, which is obviously the most kind of obvious example, but also Russia. And I think one thing we've seen through this crisis that has received relatively less, headlines than it would have otherwise, given what was happening in the Middle East, is just how relentless the attacks from the Ukrainians have been against the Russian refineries, particularly through this war. And that we saw video, was it last week or the week before, of the large-scale drone attacks against refineries in Moscow. And we heard word this morning that Moscow refinery is likely now to remain offline for the rest of the year. So we're losing big chunks of refining capacity through this crisis as well. That's kind of further tightening those markets. Yeah. Well, at the same time, in some ways, loosening the crude oil market, right? Because when you think about, you and I don't consume crude oil, we consume refined products. So if there's no refineries to do the transformations, we're going to be short refined products, but we're also going to be short crude oil demand on the other side. So this is further contributing to that buyer strike and that surge in product coming out of the Middle East.
So this is really hitting the whole production line. This is, it sounds obvious to say, but like you say, it's not really just that raw material element that's the knock-on effect of this has had, it's all the way down that line. And talking about demand destruction from the perspective of the end user, the American transport companies, and European airline, airplane, and air. What's the so travel companies and whatever. Do you see? Is it way too soon to see any fundamental change in that demand yet, and maybe the longer term effects of this? What do you look for in midterm to long term in terms of where this space is going to be now, where the market's going to be, both from supply and demand side?
You mean in terms of like longer term demand destruction?
Yeah, a bit more longer term demand structure. Is that can you not? Do you not have?
Here's the thing. I think that if this crisis had gone the way I expected it to, which was that we were going to need to hit demand destructive pricing, which is where you would have gotten that $150, $200 kind of oil prices. I think that if we had had that world, I think there would have been long-term scarring. There would have been a kind of like we saw coming out of the oil crises of the 70s. You saw a big downgrade, durable downgrade in demand for these products. I think now, however, the fact that we have seen, by and large, the avoidance of the worst of these shocks, at least at the headline level, because of China, because of the SPR releases, because of everything else, I think this has also reduced that kind of longer-term demand destructive impulse. So I would say net-net, I am not expecting as large a demand loss coming out of this as I would have otherwise. Right. And even for products like jet fuel, that was the kind of obviously the epicenter of the initial concern. One thing we saw there that's also been, always been thought possible but never really realized was the degree to which refineries were able to shift the products they produce, given the crude they have available. So what we saw, let's say in the United States, was a 1.5 percentage point decrease in the yield of gasoline, and a 1.5 percentage point increase in the yield of jet fuel. And this really helped kind of solve that jet fuel shortage, because, you're taking from the gasoline market, which is huge, and you're putting into the jet fuel market, which is relatively smaller, like 1/4 to 1/5 the size. And I think that is one of those things that further helped, address those shortages that we thought were going to really roil activity through the summer, particularly as we kind of hit peak flight season.
Okay. You give me a great you give me a great summary of where we're at the moment, and that medium term sort of outlook. If we don't, after the 60-day sort of cessation and this MOU, the 60-day window, do you see a situation? And again, we don't know the future. We can't see into the future. We know that the US Capitol Hill has basically stopped President Trump from restarting this war with Iran from that perspective, but he's found ways around things before. That doesn't discount for the Israel element of all this. Is the market now hardened and more? Should we start again in 60 days, for example, when the violence starts again? Do you think that's enough time between what we've seen and the resumption of any kind of war for the market now to have got it within its grasp and to have a better reaction function to any sort of future violence potentially?
Kind of what would happen if the war sparked back on?
So if it starts again, we've seen that there has been oil transported through and around, and pipelines and everything else. Is there enough now infrastructure in place that will make this a less drastic impact next time, if there is a next time, or a resumption of the war between the two countries?
Yeah, so I think let's say there was a resumption the next month, I don't think enough has changed to really address things. And in fact, we've whittled down so much of the buffers that we had, that we've depended on through this crisis, that we would be in a much harder position to weather that if we decided to go for pot shots at refineries and upstream facilities again in the next little while. I think over, say, the next couple of years, I do think that to some degree, Hormuz is a decaying strategic asset that we've, all of these countries had never had to avoid Hormuz before. There was always some question about the degree to which all of those offsets, the East-West pipeline, the Emirati pipeline to Fujairah, all of these pipelines, there were open questions as to how long and to what degree those would work in practice, because they've never really been, test run before.
Sure.
Those have all worked well, and as hoped. And the countries involved, particularly Saudi Arabia and the UAE, are doubling down on those rerouting assets. I would guarantee that Saudi is going to further buttress and build out the East-West pipeline to the Red Sea. And we already know for a fact that the UAE was twinning or doubling the pipeline to Fujairah on the Gulf of Oman, and they've accelerated, for obvious reasons, they've accelerated that construction. So that apparently is now 50% done. And now they have a third pipeline that they're planning on building along the same route that will be a batch pipeline that will allow products and other things to go in addition to crude oil. So overall, yeah, I think, there is definitely a move among the countries to, insulate themselves against this in the future. The trouble with that is that how Iran has, exerted pressure on the strait is largely through drones and missiles. The same things they've used to threaten and attack, assets and other production facilities across the region. Even if they have pipelines to reroute around Hormuz, those Iranian missiles and drones could still, for instance, hit the port of Fujairah, where the Emirati pipelines come out. We saw Fujairah hit multiple times through this crisis.
Yeah.
So it does not remove Iran's leverage entirely, but I think it's far easier for it to exert passive, kind of non-critical, aggressive control over Hormuz, where it's really hard to kind of modulate pot shots, missiles, and drones. So I think that it doesn't remove the tail risk, but I think it does lift the bar of how Iran would have to engage with these countries if it wanted to threaten them again.
Sure. We're coming to the end of this episode, and it's been really enlightening. But I want to just get your take then on, I guess, where you see the story next. Where would you, if you were trading a range of products? I mean, is LNG still the story in terms of volatility, price volatility, or whatever? Where do you see opportunities for traders, for investors, for example, within that production line from raw material through to refined products or whatever? Is there a story that and an opportunity as you see it moving forward?
Well, I think on a couple things. I think on I don't do LNG as much anymore, so I'll refrain from touching an area I don't know that much about on a tactical level. But on the crude oil side, I think there's going to be a big question here around timing. Obviously, we're going to get the surge of exits out of Hormuz. We're not going to see as quick a resumption of production and loadings. So we're going to see the surge followed by a petering out again. And that will be the question of when that happens and where we kind of stabilize on the other side. That's still largely unknown. And beyond that, on the refining side, I think, these crack spreads, these refining margins with gasoline nearly at 50 and diesel still around, just shy of 60, these are unsustainably high refining crack spreads. So I think that over time, we're going to need to see a resumption of more refining kind of output, more crude pushed through these refineries. So you would expect to see over time kind of a narrowing of the weakness we see in crude and the strength we see in refined products. Excellent.
Honestly, I look at oil, and as a news service, we look at the headlines that hit maybe that front month price more dramatically than maybe further down the curve or whatever. But just having you on to just really explain and to break down not just raw materials, as I said, from oil itself, the liquid stuff, but all the way through the refining process and the impact it has on each sector, I found really illuminating. So thank you very much, Rory, for that. It's I just really do get a lot out of our chats, and hopefully I know our listeners do, because they've fed back and told me they do. And we'd love to get you on again in a couple of months' time, hopefully 60 days from now, and everything is still good and everything's still fine, and the world's starting to move on from this Middle East crisis. But either way, I think it's just great to get just a bit of an update from you in terms of what we really should be looking at. So thank you very much for taking part in today's episode.
Thanks for having me.
Excellent. Thank you. Anyone who's missed the start of this, please go back and you can listen to it on the socials or on the podcast platforms. And as I said, we'll try and get Rory back in a couple of months' time to give us maybe an update on where we're at with the energy sector and oil in particular. And there's some of the driving factors behind that. So thank you all for listening. Rory, thank you for being the guest. And everyone, stay safe, and we'll see you again soon.
LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.